You see the headline claiming tech giant X just doubled its profits and AI will change humanity, giving you that familiar itch to log into your brokerage app and go all in. But here's the bleak reality. While you're mashing that buy button, the CEO of that exact same company has already quietly sold off a massive chunk of their personal shares. I know that sounds insane, and you're probably thinking it's just conspiracy clickbait, but I need you to stay with me for the next 10 minutes. I'm going to show you exactly how the financial media, Wall Street public relations, and corporate boardrooms have spent decades making sure you never figure out how they actually exit their trades. The filings are real, the market structure is well documented, and by the end of this video, you will finally stop being Wall Street exit liquidity. Instead, you will start becoming the rare trader who just steps aside right before the bubble inevitably bursts. So let me show you how this actually works. Here's what got me started down this exhausted rabbit hole, watching retail investors get absolutely slaughtered on a supposedly bulletproof tech stock, which made me start digging into the SEC filings. What I found was honestly pretty uncomfortable, proving that one of our biggest mistakes is treating Bloomberg headlines or corporate talking heads as actual trading signals. You need to understand a harsh and fundamental truth about the stock market. Because by the time a major bullish catalyst hits your phone as a push notification, it's already worthless. Institutions are not trading with an $8,000 Robinhood account. They're managing positions worth billions, meaning they simply cannot just hit sell at market. If an institutional block desk dumped everything on a Tuesday morning, they would instantly chew through every buy order on the exchange and completely collapse the price. They would completely destroy their own wealth before they even finished selling. So to actually get out, they need something far more important, which is liquidity. And where does that magical liquidity come from? It comes directly from you, because they desperately need your optimism and carefully engineered narratives. They need a rushing and massive river of eager buyers to somehow absorb the crushing weight of their endless selling. That is exactly why, during the very same week, a company dominates the news with sweeping promises about the future. The executives are simultaneously filing insider selling disclosures. Exiting a massive position is never just a single transaction. It's a highly coordinated and strategic military operation where they are forced to completely manufacture demand. They have to create a psychological state where any hesitation feels like you're missing out on generational wealth, relying entirely on a predictable four-step playbook. Step 1 is releasing blowout earnings reports, carefully massaged with non-GAAP accounting tricks to look absolutely flawless to the easily manipulated public. Then comes the grand narratives, casually dropping the perfect buzzwords on earnings calls, followed by synchronized upgrades where bank analysts magically raise their price targets in unison. Next is the media amplification, watching financial networks regurgitate press releases like it's objective journalism, while retail investors blindly rush in, fueled by fear of missing out. And while you're smashing market buy orders, the insiders are just quietly sitting there on the ask, methodically handing their heavy bags directly to you. Let me ask you something completely blunt. If this company truly has massive upside like the polished headlines claim, why are the people who know the business best furiously cashing out? They sit comfortably in the headquarters, seeing the real-time supply chain data and customer acquisition costs months before those numbers ever get scrubbed for the public. They know the actual risks, and yet they're hitting the sell button, a glaring contradiction that alone should make you immediately stop in your tracks. Before we go any further, I want to address the obvious counterargument, because I know exactly what the finance bros are eagerly typing in the comments right now. Someone is going to tell me to relax, claiming it's just a 10b5-1 trading plan, a pre-scheduled blind trust that absolutely does not mean anything. And honestly, that explanation sounds incredibly reasonable. It sounds highly professional, but it's also a dangerously incomplete way to view the bleak situation. The 10b5-1 rule was designed by the SEC so executives could sell stock without getting sued for insider trading, making it look completely hands-off. The idea is simple. You set up a schedule way in advance, and a broker cleanly handles it, which all sounds perfectly fair on the surface, right? But here's the catch that financial networks conveniently forget to mention. These plans can be quietly modified, canceled altogether without penalty, and do not require detailed public justification. Even worse, some of these supposedly pre-planned schedules are drafted just days before the heavy selling begins, forcing you to think about the sheer and unfair advantage of that. If an executive knows a massive government contract is dropping next month, they can quietly call their broker, cancel their sell plan, and profitably ride the wave to the top. But if their internal dashboards show a brutal earnings miss coming, they can legally set up a new plan to offload shares before the real disaster hits the news. It's practically a risk-free put option, leaving you holding the bag while they quietly exit through the back door with millions. So when a public relations rep tells you it's just a scheduled sale, do not take the bait, because regardless of the legal cover, the final result is exactly the same. They are inevitably converting their stock into hard cash, And that is absolutely the only actual signal you should ever care about. Here is where it gets really interesting. And by the way, my analytics show about 70% of the people watching this video right now aren't subscribed. If this kind of deep dive practical market reality check is actually useful to you, hit subscribe, because I go after this bleak stuff every single week. It cuts through the endless corporate noise and actually saves you real money. So let's get right back to looking at the chart. Stick with me here, because what I'm about to tell you is the exact part that actually made me incredibly angry when I first put it together. We need to talk about the deceptive reality of stock buybacks, especially when you see the headline claiming a company announces a massive $50 billion share repurchase program. We are foolishly trained to think this is incredibly bullish. Believing fewer shares and higher earnings per share simply means that management is confident, right? But let's take a closer look at the actual plumbing of the transaction and ask yourself where that $50 billion actually comes from. It comes straight from the corporate treasury, and it is the company cash, which means it is ultimately your cash as a deeply neglected shareholder. Instead of building better products or paying you a dividend, the company acts as a blind and price-insensitive buyer in the open market. They are hoovering up shares at sky-high valuations, which deliberately creates a massive and completely artificial floor beneath the dying stock. But here is the cynical trick, because while the corporate entity is mechanically buying millions of shares, the executives are aggressively selling their personal shares. It is a perfectly closed loop where the company uses billions in corporate cash to violently build a wall of entirely artificial demand. Retail inevitably jumps in because the chart looks amazing, letting executives route their personal sell orders directly into that massive pool of corporate liquidity. The miserable end result is that the executives walk away with generational wealth and hard cash, leaving the corporate balance sheet completely drained. Retail is just left holding overvalued shares right before the music stops, making it a highly optimized and completely legal wealth transfer. So how do you actually spot this deception on a chart? Well, let's look at the basic market structure that dictates every single move. Every asset goes through 4 specific phases, starting with accumulation, where smart money buys low, and moving into the markup, which is the uptrend. Then comes distribution, where smart money quietly sells high, inevitably followed by the decline, which is just the final and devastating crash. The absolute most dangerous place for you to be is the distribution phase, because this is the psychological peak where fear of missing out is at a fever pitch. But just beneath the polished surface, the price action starts acting weird, forcing you to carefully watch for volume price divergence. Trading volume goes completely through the roof as millions of shares are changing hands, and manipulated retail investors are blindly buying like crazy. But the price isn't actually going up anymore. It's just moving sideways in a suspiciously heavy and agonizingly choppy range. Because every single time retail foolishly tries to push the price up, a massive and hidden institutional anvil quietly drops right on top of it. If you look closely at the daily candlesticks, you will start seeing long upper wicks, which aren't just meaningless shapes on your trading screen. That is the bleak visual footprint of a failed advance, meaning buyers pushed the price up during the day with desperate optimism. But by the close of the session, massive hidden supply flooded the open market and ruthlessly slammed the price right back down. We saw this exact miserable thing happen in late 2021 with the metaverse hype, where the corporate narrative was flawless and the trading volume was massive. But the price fundamentally could not break its highs, and meanwhile, the wealthy insiders were just quietly dumping their shares every single day. It was simply cold math when the insiders finally finished selling. They completely pulled, the artificial support and brutal gravity finally took over. Then came the inevitable earnings miss, and the stock violently gapped down 25% in a single day, proving that wasn't just a random crash. And please do not rely on traditional PE ratios to magically save you here, even when analysts enthusiastically claim it's trading at a cheap multiple. You need to listen to me right now, because corporate earnings are nothing more than a heavily manipulated photograph of the dead past. At the absolute psychological peak of a market cycle, corporate profits always look amazing to the untrained and overly optimistic eye. Because the earnings part of the equation is temporarily bloated, the PE ratio looks deceptively low and creates a devastatingly classic value trap. What the wealthy insiders know and what you completely miss is that forward-looking data is quietly deteriorating right under your nose. New corporate orders are rapidly slowing and margins are painfully compressing, inevitably leading to a brutal drop in future reported earnings. Once those earnings drop, that supposedly cheap multiple instantly becomes a wildly overpriced nightmare that will absolutely destroy your portfolio. The stock inevitably crashes because the bleak future no longer justifies the heavily manipulated present, leaving you wondering what is actually real. So if the media news is fake and the PE is entirely backward, what do you actually trust when charts can be effortlessly manipulated? It's actually very simple. You just watch exactly what they do with their own personal money instead of listening to what they say on a podcast. You have to ignore their polished words and only pay attention to what they actually do. using a framework that takes 5 minutes a day for free. Step 1 is to simply go to the Open Insider website or the SEC EDGAR database, completely bypassing the mainstream financial noise. Step 2 is to just type in the ticker symbol of the stock you naively want to buy and prepare yourself for the uncomfortable truth. Step 3 is to filter for Form 4 filings, because by law, these insiders have to report their shady trades here within 2 business days. Step 4 requires you to completely ignore the confusing legal jargon and strictly look at the transaction code along with the total trade volume. This actually matters, so please pay close attention, because if you see code M, that's just them routinely exercising their stock options. But if you see code S, that means an open market sale, proving they are taking their stock and ruthlessly dumping it on you for cold cash. Step 5 requires you to carefully look for cluster selling, because if just one guy sells some stock, he might simply be getting a divorce. But if you see the CEO and 3 board members all file code S sales in a 2-week window, that is a massive and terrifying siren. You operate in a cynical world of asymmetric information, meaning you're always going to be the absolute last person to know the ugly truth. But SEC filings finally give you a legally mandated look right behind the corporate curtain, so you absolutely must start using it to your advantage today. If you see coordinated insider selling while the media is aggressively screaming to buy, just step completely aside even if the stock is still slowly creeping up. You must let someone else be their exit liquidity, because long-term survival matters infinitely more than squeezing out the last 2% of a dying rally. Wall Street's ultimate secret was never about having a faster trading algorithm. It was simply making absolutely sure you never even thought to look at the paperwork. Try looking up those Form 4s before you blindly buy your next stock, because I absolutely guarantee it will brutally change how you view the market forever. Drop a comment below and tell me the one stock you're holding right now, so I can finally do a deep dive forensic analysis on it. I personally read every single comment to shape exactly what I build next, so stay incredibly sharp and stay skeptical as you always follow the money.